Hello everybody. Today we are going to discuss about some introductory part of partnership. As you know, partnership is nothing but two or more people coming together and doing the business. In this session, we are going to discuss about definition of partnership, partnership deed, some provisions of Indian Partnership Act 1932, and most importantly, methods of preparing capital account. There are two methods, fluctuating capital method and fixed capital method. Let's go through the definition. Under Section 4 of the Partnership Act 1932, partnership is defined as it is a relations between persons who have agreed to share profits of a business carried on by all or any one of them acting for all. That means partnership is nothing but an agreement where people come together to do the business. Either all of them do the business together or one of them do on behalf of others. There is a sharing of profits also. Partnership deed. This is an important part of every partnership business. Partnership deed is nothing but a written or oral agreement between the partners. It is as a roadmap in the functioning of partnership firm. It shows all the details about the partnership, such as name of the firm, address of the firm, name and address and responsibilities, authorities of all the partners, how the profits will be shared. All these details are recorded in the partnership deed. Let's discuss about provisions of Indian Partnership Act 1932. I'm taking only few important provisions with respect to the accounting terms. The first important is distribution of profit. Unless otherwise specifically mentioned, the profits will be distributed amongst the partner equally. If they want to have a different profit sharing ratio, such mention should be there in the partnership deed. Second is interest on drawings. When a partner withdraws a certain amount for personal use, it is called as drawings. In that case, if the period of the drawings is not mentioned, the interest will be calculated for 6 months. If the partnership deed is silent about the interest on drawings, no interest is paid. That means interest on drawings should be mentioned in the partnership deed. Next is interest on capital. It is given to the partners only if such provisions is mentioned in the partnership deed. When a partner does some additional activities in the business, he is expecting interest on capital. It will be provided again if it is mentioned only in the partnership deed. Next is interest on loan. If the partner has contributed an amount in addition to capital and in the form of loan, he is entitled to an interest at 6% per annum. If the partnership deed provides certain other rate, that will be applicable. Otherwise, according to the Partnership Act, 6% per annum will be charged as interest on loan. Next is salary and commission to the partner. When partner will get extra incentives in the form of salary or remuneration for his duties performed, but such provisions are necessarily to be mentioned in partnership deed. If it is not mentioned, they are not entitled to get any salary or commission or any other form of remuneration. The most important provision in the Partnership Act is for admission of a new partner. New partner can be admitted in the partnership firm only when all the partners, existing partners, gives their consent. Even if one single partner does not intend to admit a new partner, the process of admission cannot take place. In addition to this, the necessary provisions are mentioned in a partnership deed. The partnership deed includes the provisions regarding retirement of a partner, death of a partner. There are different provisions in the partnership deed with respect to dissolution of the firm. There are provisions regarding dispute settlements amongst the partner. So these are all basic things which all the partners should know before starting of the business. Now let's concentrate on methods of preparing capital accounts. The capital accounts, in the previous standards, you are considered a sole proprietor where there are no partners. Hence, there was no necessary to prepare a capital account. Now, as there will be partners, the partners' capital account is separately recorded. It will include their capital balances, amount of drawings, interest on capital, interest on drawings, interest on loan, salary and commission of the partners. These all points we have discussed in the previous slides. All these will be recorded in the capital account. As we know, there are two methods. The first is fluctuating capital method. In this method, capital keeps on changing. As the name suggests, it is fluctuating. Because of the previous adjustments, that is interest, drawings, etc., the capital amounts keeps on changing. All those adjustments are shown on the capital account itself, and finally we get the closing capital. Let's see what's the format of capital account in case of fluctuating capital method. On the left hand side, you will see that it is drawings, interest on drawings, P&L. If there is a loss, the partners will get the losses distributed. That loss distribution will come on the debit side. On the credit side, the first item is balance brought down, that is the opening capital figure. Then it is by cash. If any additional amount contributed by the partners, it will be recorded on the credit side. You know the journal entry, cash account debit to partners capital account. So it will go to cash account debit and credit of partners capital. Interest on capital will be on the credit side. Salary commission will also be on the credit side because those are the expenses from business point of view, but income from partners point of view. So it will be added in the capital. To add it in the capital, we need to show it on the credit side of the capital. The last is distribution of profit. If there is a profit at the end of the year, that will be distributed on the credit side. If there is a loss, it will be distributed on the debit side. So considering all these things, the partners capital account will include their opening capitals, additional capital, interest on capital, salary, commission and profit share on the credit side, and on the debit side it will be drawings, interest on drawings and distribution of losses. If you consider the fixed capital method, the capital remains fixed. As the name suggests, the capital remains fixed. So all the adjustments in the form of drawings, interest on drawings, interest on capital, salary, etc. will be shown on a separate account called as current account. So in fixed capital method, we need to prepare two accounts, capital account and current account. Let's see the format. This is the format of capital account. On the capital account, you will find it on the credit side balance brought down, that is the opening figure of capital. Then by cash, any additional amount contributed. Debit side to drawings, if the capital is withdrawn, then the balancing figure will be carried down. So here it will be only having the items related to capital, opening capital, additional capital, capital withdrawn and closing capital. Only this much part will be included in capital account. Whereas in current account, on the credit side, we can have balance brought down, the opening figure. As we have seen in the previous case, interest on capital, salary, commission, share of profit will be on the credit side. On the debit side, it will be drawings, interest on drawings and share of losses. You will find that on both the sides, I have recorded balance brought down because the current account may have either debit balance or credit balance. Whichever the balance is given, it is to be recorded at that particular place. It is possible that one of the partner will have a debit balance and the other partner will have credit balance. That way it should be recorded. Similarly, on the closing also, it is possible to have on the debit as well as credit.